Merry Christmas. I know I already said it. I told you earlier to turn off the screens, forget the markets, and be present with your family. That was the plan. I actually tried. I poured a glass of wine, shut everything down, and promised myself I wouldn't look at a single chart for the rest of the day. But I wouldn't be back on this camera right now if what just crossed my desk wasn't urgent. This isn't noise. This isn't speculation. This is an emergency. I need you to pause for a moment, put down the eggnog, step away from the headlines. What I'm about to share did not come from social media or a rumor. It came from verified settlement data out of Asia, and it signals something far more serious than a normal market move. The Chinese silver market just sent a warning that cannot be ignored. Not a forecast, not a chart pattern. Math. Cold, unforgiving math. The kind that exposes stress fractures before the system breaks. Here is the number that matters, $80. That is the real price of physical silver in Shanghai right now. Not paper promises, not futures games, actual metal being settled in the world's largest manufacturing economy. Now open your U.S. trading app, low 70s. That gap should not exist. In a healthy market, it wouldn't. If silver were truly cheaper, in New York, banks would buy it here, ship it east, and lock in risk-free profit. That mechanism is called arbitrage. It's the gravity that keeps global prices aligned. And when gravity shuts off, something underneath has failed. So why interrupt a holiday? Because tomorrow, the U.S. market reopens into Ghost Week, the thinnest, most illiquid trading window of the year. And right now, there is a powerful vacuum pulling prices toward reality. Markets do not tolerate vacuums. They resolve them fast, and they resolve them violently. What happens next explains why this gap exists, why it's growing, and why ignoring it could be a mistake you don't get to undo. If you're still with me, type 1 in the comments so I know you see what's coming. Let's slow this down and remove any doubt because skepticism is healthy here. Whenever a number like this appears, the first reaction is disbelief. People assume it's a typo, a currency mistake, or a misunderstanding of units. So instead of asking you to trust me, we're going to walk through the math together, step by step using official data. The price I'm referencing comes from the Shanghai Futures Exchange front-month silver contract. This is not a rumor. It is the settlement price used by industrial buyers who actually take delivery. That contract closed just before the holiday at 18,145 yuan per kilogram. That number alone doesn't mean much until you translate it properly, which is where most people get lost. First, convert yuan to dollars using the current exchange rate. That brings the price to roughly $2,500 per kilogram. Next, convert kilograms into troy ounces because silver is not measured in standard ounces. There are 32.15 troy ounces in a kilogram. Divide it out. The result lands just over $80 per ounce. No tricks, no assumptions, just arithmetic. Now look back at New York, 71. 72 if you're lucky. That difference isn't a spread you hedge. It's a warning sign. In professional trading, a gap like this means one thing. The market mechanism that is supposed to keep prices honest is failing. Because here's the rule that never breaks until it does. If an asset is cheaper in one place and more expensive in another, capital moves, metal moves, profit is harvested. That process erases the gap. When the gap doesn't close, it means the trade cannot be executed. And that leaves only two possibilities. Either the metal in the West cannot be sourced in size, or it cannot be moved at all. Both scenarios point to the same conclusion: paper prices and physical reality have separated. This is where most investors make their first mistake. They assume the paper price is truth, and the physical price is an anomaly. History shows the opposite. When the two diverge, paper always adjusts last, and it never does so calmly. In the next chapter, we're going to answer the real question: why China is willing to pay up and why they are doing it right now. Now we get to the core of what most people are missing, because price gaps like this don't appear randomly. China is not paying $80 for silver because they expect a quick trade. They are paying it because waiting has become more dangerous than overpaying. If this were a speculative frenzy, the buyers would be obvious. Hedge funds chasing momentum, retail traders piling into charts. That is not what the data shows. The surge in volume on the Shanghai Exchange is coming from commercial hedging accounts. In plain terms, it's coming from factories. This is not a financial run, it's an industrial run. When banks panic, they want liquidity. When factories panic, they want raw material. If they don't get it, production stops, contracts fail, and the business starts bleeding immediately. In that environment, price becomes irrelevant. Availability becomes everything. Solar manufacturing is the first pressure point. China controls the vast majority of global solar panel production. For years, analysts claimed silver demand would fall as engineers reduced usage per panel. That process has now hit its physical limit. Recent industry data confirms silver consumption per watt is no longer declining. The chemistry cannot be pushed further without sacrificing efficiency. At the same time, manufacturers are rapidly shifting to higher efficiency cell technologies that require significantly more silver per unit. Demand is rising just as mine supply is stagnating. That's why factories are skipping traditional suppliers and going straight to the exchange to take delivery. Investment-grade bars are being melted down to keep production lines alive. But solar alone doesn't explain the urgency. Electric vehicles are the second shock. Next-generation battery technologies dramatically increase silver usage per car. Chinese manufacturers see this coming years in advance. They are not reacting to headlines, they are securing supply before the bottleneck becomes visible. When industrial buyers decide supply risk outweighs price risk, markets don't adjust gradually. They snap. In the next chapter, we'll examine what this behavior is doing to inventories, and why the word shortage is no longer strong enough to describe what's unfolding. To understand how serious this has become, you have to stop looking at price and start looking at inventory. Price tells you what people think. Inventory tells you what they're actually doing. And right now, the inventory data coming out of China is flashing red. Look at the warehouse stocks tied to the Shanghai exchange. Just a few years ago, those warehouses held thousands of tons of silver. That metal acted as a buffer, a shock absorber for demand spikes. Today, that buffer is gone. Visible inventories have been drawn down aggressively, and more importantly, the metal available for immediate delivery is approaching zero. This is where the market sends its most honest signal: backwardation. In a normal market, future prices are higher than spot prices. You get paid to wait because storage and financing cost money. Backwardation flips that logic upside down. It means buyers are willing to pay more today than they are for delivery next month. In simple terms, they don't trust future supply. Right now in China, buyers are saying, "Don't promise me silver later, I don't believe you, I need it now." That is not speculation, that is fear of interruption. This is what a real shortage looks like. Not empty shelves on a website, but factories refusing to accept future delivery contracts. They are voting with capital, pulling metal out of the system as fast as it appears. Once backwardation shows up at scale, it rarely resolves so peacefully. Now contrast that with the West. Traders in New York are staring at charts, dollar indexes, and technical levels. They're trading silver like it's a currency proxy. China is treating silver like a strategic input. Those two perspectives cannot coexist for long. Every ounce that leaves inventory tightens the noose further. Less metal means less liquidity. Less liquidity means smaller trades move prices more violently. This is how calm markets turn unstable without warning. And this brings us to the most uncomfortable question of all. If there is a clear profit opportunity sitting in front of every major bank on earth, why isn't anyone taking it? That question is the key to everything that comes next. At this point, every experienced trader is asking the same question, even if they're not saying it out loud. If there is a clean, visible profit between New York and Shanghai, why aren't the biggest institutions on earth exploiting it? Wall Street exists to close gaps like this. Banks deploy supercomputers to scalp fractions of a cent. A multi-dollar arbitrage should be irresistible. And yet the gap is widening. That tells you everything you need to know. If silver were truly available in the West, the trade would already be done. Banks would be buying futures standing for delivery, loading bars onto planes and selling them into Shanghai. It would be free money. The fact that it isn't happening means the metal cannot be sourced in size or it cannot be moved at all. This is where theory collides with reality. Paper silver trades instantly. Physical silver does not. You have to locate it, insure it, transport it, and deliver it. And right now that chain is breaking. We are hearing reports from logistics and vaulting channels that should never be stressed at the same time. Refineries are booked weeks out. Vault operators need days to locate specific bars. That phrase alone should make your skin crawl. In a modern vaulting system, every bar should be accounted for instantly. When a vault needs time to find your metal, it usually means the metal isn't sitting where the paper says it is. At best, it's tied up. At worst, it's been promised more than once. This is why arbitrage has failed. The banks aren't ignoring the opportunity, they're trapped by it. Every attempt to close the gap exposes the fact that the physical inventory backing the paper market is dangerously thin. And this brings us to the moment when things stop being abstract. Because while traders argue online, something very real is happening inside Western vaults. Metal is leaving, not gradually, not quietly. It's being pulled out in size. In the next chapter, we're going to look at the hard inventory data that confirms this drain is already underway and why it changes the risk profile of the entire market overnight. Now we move from theory to proof, because this is where the story stops being a warning and starts becoming a record of events. While most people were distracted by the holidays, the Western exchanges quietly released their latest inventory data. And buried inside those numbers is the confirmation that something is breaking. Focus on registered inventory, not eligible. Eligible metal can belong to anyone and may never be for sale. Registered inventory is different. That is the metal fully warranted and available for immediate delivery. It is the lifeblood of the futures market. Without it, contracts are just promises with no anchor. In a single trading day, one major refining vault saw more than 1 million ounces leave the registered category. Other vaults followed with additional large withdrawals. This wasn't retail buying coins. This wasn't investors playing games. This was institutional-sized metal being removed from the system. That is what a run looks like in a commodities market. When registered inventory drains this fast, it creates a feedback loop. The less metal remains, the harder it is for banks to manage delivery risk. The harder delivery becomes, the less willing they are to sell paper contracts. And the less paper available, the more violently price reacts to demand. This is why the arbitrage gap keeps growing instead of closing. The same demand pushing Shanghai higher is simultaneously emptying Western vaults. Every ounce removed makes the next ounce harder to source. The market begins feeding on itself. This is also where confidence evaporates. Futures markets only work as long as participants believe delivery is possible. Once that belief weakens, behavior changes instantly. Buyers stop trusting future promises. Sellers hesitate. Liquidity vanishes. And that's the backdrop for what happens next. Because tomorrow the U.S. market reopens into the lowest liquidity window of the entire year. Skeleton crews, thin order books, automated systems running without human restraint, a market already hollowed out facing a price signal it can no longer ignore. In the next chapter, we're going to walk through exactly how this kind of setup turns a price discrepancy into a sudden violent repricing, and why timing matters more than most people realize. This is where structure meets timing, and why the next move rarely gives people a second chance. Markets don't break when everyone is watching. They break when attention is low and liquidity is thin. That is exactly the environment we are entering. The days between Christmas and New Year are known as Ghost Week for a reason. Senior traders are away. Risk desks are understaffed. Order books are shallow. Under normal conditions, that just means quiet trading. But there is nothing normal about a market carrying a multi-dollar disconnect from physical reality. When liquidity disappears, price stops moving in steps and starts moving in jumps. Here's how it happens. A single large buyer often industrial places an order to hedge near-term production. They are not speculating, they are not timing the market. They simply need coverage. In a liquid market, that order gets absorbed. In Ghost Week, it hits an empty room. There are no offers where price last traded, so the order climbs the book, filling higher and higher levels just to get executed. What should have been a small move becomes a sudden gap. Algorithms see that gap and react instantly. They don't understand context. They only understand imbalance. Now the feedback loop begins. Rising price triggers more automated buying. Options hedging forces banks to chase the move to manage risk. Each forced purchase pushes price higher, which triggers the next round. This is how markets detach from recent history in hours instead of months. The key point is this: none of these participants are acting irrationally. They are responding to a structure that no longer has enough metal to dampen volatility. Once that structure fails, price becomes the only release valve. This is why watching headlines will mislead you. The explanation always comes after the move, never before. By the time the story makes sense to everyone, the repricing has already happened. In the next chapter, we'll address the most dangerous mistake investors make in moments like this, assuming that the first big move is the end rather than the beginning. This is the psychological trap that catches even experienced investors. When price finally moves, when silver jumps into the high 70s or touches 80, the instinct is to breathe a sigh of relief and assume the event is over. Crisis resolved. Bubble popped. Time to sell and move on. That instinct is wrong. Violent moves don't end structural problems, they expose them. When a market reprices this fast, it isn't finding equilibrium. It's searching for it. The first surge is simply the point where denial breaks. After that, behavior changes, and behavior is what drives the next phase. For decades, global industry operated on just-in-time supply. You didn't hoard metal, you trusted the market. You assumed that if you needed silver next month, you could buy it next month. A $9 premium destroys that trust overnight. It tells every procurement manager the same thing: availability is no longer guaranteed. Once trust breaks, hoarding begins. This is where price elasticity disappears. If you're building a $50,000 electric vehicle, the difference between $70 silver and $90 silver is irrelevant. What matters is whether the car can be built at all. The same logic applies to solar panels, electronics, and infrastructure. Silver is a small cost component, but a critical one. This is why $80 is not a ceiling. It's a psychological line in the sand. Once crossed, it reframes the conversation. Executives stop asking, "Is this expensive?" and start asking, "How much do we need and how fast can we get it?" Meanwhile, Western investors are still anchored to old numbers. 30 felt high, 50 felt extreme. That conditioning becomes dangerous in a regime change. Markets don't care what used to feel expensive, they care about clearing supply. The real risk now isn't volatility, it's hesitation. Waiting for a perfect pullback in a structurally tight market often means watching price move without you. By the time calm returns, the opportunity is gone. In the next chapter, we're going to talk about strategy. Not hype, not panic, but how to think clearly when price discovery replaces price control. When a market moves from control into true price discovery, prediction stops working and discipline takes over. This is the phase where most participants fail, not because they're wrong about direction, but because they're emotionally unprepared for the movement. The first trap is anchoring to the dollar price. The number on the screen feels real, but in stress markets, it often isn't. If silver is quoted at 80, yet cannot be sourced anywhere near that level, the quote is just a reference, not a transaction. Availability matters more than optics. A better compass is relative value. Historically, during genuine supply stress, the gold-to-silver ratio compresses aggressively. It doesn't drift slowly, it snaps. Until that ratio normalizes, silver remains undervalued in structural terms, regardless of how uncomfortable the headline price feels. The second trap is reacting to paper volatility. Thin liquidity creates sudden drops that look like trend reversals but aren't. Flash moves shake confidence, not fundamentals. If physical premiums stay elevated, those dips are dislocations, not signals to exit. This is where conviction is tested. A thesis built on industrial demand, inventory depletion, and logistics failure does not change because price swings $5 in an afternoon. Volatility is the cost of admission, not a warning sign. Position sizing also becomes critical. Too much exposure forces emotional decisions. Too little creates hesitation and regret. The goal is balance, allowing you to hold through turbulence without panic or paralysis. Markets don't reward perfect timing during regime shifts. They reward understanding. Those who recognize the change early and stay disciplined are the ones who emerge intact. In the final chapter, we'll step back from the charts and talk about what this moment really represents, the lessons it carries, and how to act with clarity as the next phase unfolds. Step back for a moment, because this has never been only about silver. What we are witnessing is a shift in how value is discovered. For decades, prices were set in paper markets far from physical reality. That system worked because trust existed and supply felt endless. Both assumptions are now breaking. When physical scarcity appears, pricing power moves away from abstraction and toward necessity. Factories, logistics, and strategic planning begin to matter more than charts. Price stops being a convenience and becomes a signal that stress has entered the system. Markets never announce these shifts cleanly. They start with confusion, then volatility. Clarity only comes after repricing has already occurred. Most people wait for confirmation, but confirmation always arrives late. Those who act early are not guessing. They understand structure before consensus forms. The lesson here is not about chasing price, it's about respecting scarcity. When industrial demand collides with limited supply, repricing is inevitable.